Welcome. I am your financial advisor, and today we're discussing an investment strategy beyond traditional stocks and real estate. We'll explore safer and smarter ways to grow your wealth with high-yield savings and Treasury bonds, focusing on security, high yield, and low risk. Traditional assets come with hidden dangers. Stocks suffer from volatility, as seen in the 38% S&P 500 crash in 2008. Real estate demands large capital and months to liquidate. Both bring complexity and stress, with 67% of investors reporting stress. There is a better foundation for your portfolio. Our first solution is the high-yield savings account, or HYSA. This bank account pays significantly more interest, often 10 to 15 times a standard savings account. Your principal is safe, as it's FDIC or NCUA, insured up to $250,000. Earning 4.5% to 5.5% APY, this cash is liquid and compounds daily. For example, $10,000 saved for 1 year at 5% APY earns $500 risk-free. This slide provides an overview of the high-yield savings account, emphasizing its FDIC NCUA insurance up to $250,000 and the high APY rates compared to traditional savings. Solution number 2 is U.S. Treasury Bonds, the world's safest investment. You lend money to the U.S. government, which pays fixed interest and returns your principal at maturity. These are backed by the full faith and credit of the United States. Today's yields are historically high across T-bills, T-notes, T-bonds, and inflation-linked TIPS. When comparing investments, both HYSA and T-bonds offer perfect safety with competitive returns of around 5% compared to 7% to 10% for stocks. However, T-bonds and HYSAs have very low complexity and high liquidity, achieving near-identical returns to equities with a fraction of the risk. Here is your smart allocation blueprint. Allocate 30% to HYSA for emergency funds, 40% to T-bonds as your core wealth engine, and 20% to growth equities using low-cost index funds only. The final 10% is for alternatives, suitable only for experienced investors. This blend balances income, safety, growth, and liquidity. The Treasury Bond Ladder is an income machine. It involves a portfolio of bonds with varying maturity dates, enabling regular income and lower rate risk. A $50,000 ladder, for example, generates about $2,400 per year in interest income. The ladder rolls, allowing you to reinvest maturing funds at the current best rates. This chart illustrates that more risk does not always mean more reward. HYSA and T-bonds offer returns of around 5%, with almost no volatility. Meanwhile, high-risk assets like stocks and crypto, while offering higher average returns, come with significantly increased volatility scores. The bond and HYSA blend offers the most efficient risk-adjusted return. Here is your 5-step action plan to start this week. First, open a high-yield savings account. Second, set up your treasurydirect.gov account. Third, begin building your bond ladder with 3-month, 6-month, and 1-year T-bills. Fourth, automate your contributions, treating savings like a bill. Finally, review your rates every 6 months to stay flexible. This slide reiterates the 5 key actions. Open an HYSA, set up a Treasury Direct account, build a bond ladder, automate contributions, and review every 6 months. Key takeaways include HYSA's high liquidity and zero risk, T-bonds offering government-guaranteed income, and the 30/40ths/20/10ths blend outperforming most portfolios. Bond ladders provide income without locking up capital. Start today, as high rates won't last forever. Take action now. Today's high-rate environment is rare, so every month you wait means missing guaranteed income. Follow Step 1 this week, Step 2 this month, and Step 3 this quarter. Your financial freedom starts with one decision today. Thank you.